With the name of Allah, you are welcome in my lecture on cost accounting. This lecture about variance analysis for revenue and costs. You can make variance analysis for revenue using selling price variance. Selling price variance equal actual selling price per unit minus budgeted selling price per unit times actual units sold. For example, if actual selling price per unit 185, budgeted selling price per unit 180, and the actual units sold equal 10,000 units. So the selling price variance equal 185 minus 180 times 10,000 units equal 50,000. Favorable or unfavorable? Favorable. Why? Because the actual selling price is greater than the budget selling price. That means the performance in this company is good. Variance analysis for manufacturing cost. Manufacturing cost consists of three elements: direct materials, direct labors, and overhead cost. In this lecture, I will explain variance analysis for direct materials. To calculate direct material costs, you need price and quantity. Also, to make variance analysis for direct material costs, you will determine price variance and quantity variance. I will use general model for cost variance analysis. That is consists of three things. Number one, actual quantity of inputs at actual price. That means actual quantity times actual price. The second one, actual quantity of input at standard price. That means actual quantity times standard price per unit. The third one, standard quantity allowed for actual output at standard price. That means standard quantity times standard price. I will explain later what is the meaning of allowed for actual output. To make price variance, actual quantity of inputs at actual price minus actual quantity of inputs at standard price. Here is the difference between price, so it's price variance. Quantity variance equal actual quantity of input at standard price minus standard quantity allowed for actual output at standard price. Here's the difference in quantity, so it's quantity variance. The total variance is actually quantity of inputs at actual price minus standard quantity allowed for actual output at standard price. This is performance report. What is the meaning of standard quantity allowed for actual output? And why I don't say standard quantity times standard price without allowed for actual output? For example, if a company budget to produce 10 units, a unit need 100 millimeter, so the budgeted quantity 1000 millimeter. If the actual result is 11 units, a unit used 95 millimeter, so the actual quantity is 1045 millimeter. The quantity variance here will be 1045 minus 1000 equal 45 unfavorable. Why unfavorable? Because the actual quantity is greater than the budgeted quantity. Look at the details. The company here produced 11 units instead of 10 units and used the material 95 instead of 100 millimeter. That means it's produced more than the budget and used the material less than the budget. How come its final result is unfavorable? So instead of budget, I used a standard quantity allowed for actual output. It's equal actual output 11 units times standard quantity 100 millimeter equal 1100 millimeter. So actual minus standard 1045 minus 1100 equal 55 favorable. Favorable because the actual quantity is less than the budget quantity. You can make variance analysis for direct material using performance report or in equation. From the performance report, price variance equal actual quantity of inputs at actual price minus actual quantity of inputs at standard price. So actual quantity here is a common factor. So actual quantity times actual price minus standard price, that's equal price variance. So price variance equal actual price minus standard price times actual quantity. Quantity variance from the performance report equal actual quantity of input at standard price minus standard quantity allowed for actual output at standard price. Here standard price is a common factor, so standard price times actual quantity of inputs minus standard quantity allowed for actual output equal quantity variance. Example 1. A company has the following data during June. Standard quantity 3 kilo per unit. Standard price $4 per kilo. Actual quantity purchased during the month 6,500 kilogram. Actual price 3.8 per kilo. Actual production units 2,000 units. The company uses the purchased quantity during the month required, make a performance report to calculate the price and the quantity variances. Number 2, calculate the price and the quantity variances in equations. To calculate price variance and the quantity variance using performance report, I will start by actual quantity of input at actual price 6,500 kilogram times 3.8 equal 24,700 minus actual quantity of input at standard price 6,500 kilogram times standard price 4 equal 26,000. The result is price variance 1,300 favorable. Why favorable? Because the actual price is less than the standard price, so the result is favorable. To calculate quantity variance, it's equal actual quantity of input at standard price 26,000 minus standard quantity allowed for actual output at standard price. Standard quantity allowed for actual output equal 2,000 times 3 equals 6,000 times standard price 4, the result is 24,000. So the quantity variance equal 2,000 unfavorable. Unfavorable because the actual quantity 6,500 is greater than standard quantity allowed for actual output 6,000. So the result is unfavorable. To calculate total variance equal actual quantity of input at standard price 24,700 minus standard quantity allowed for actual output at standard price 24,000 equal 700 unfavorable. The second required to calculate price variance and quantity variance in equation. Price variance equal actual price minus standard price times actual quantity equal 3.8 actual price minus 4 standard price times 6,500 kilogram actual quantity equal 1,300 favorable because the actual price is less than standard price. Quantity variance equal actual quantity minus standard quantity allowed for actual output times standard price. Actual quantity 6,500 kilogram minus standard quantity allowed for actual output 2,000 times standard quantity 3. That's the result 6,000. So 6,500 minus 6,000 times standard price 4 equal 2,000 unfavorable. Unfavorable because the actual quantity is greater than a standard quantity allowed for actual output. By the end of this lecture, you have skills to make variance analysis for revenue and direct material cost. Thank you and best wishes.